The entire housing market is on the verge of implosion. This assertion may appear to be bold, but it is supported by overwhelming proof. Almost every housing statistic reveals alarming trends. There are a record low mortgage applications, soaring evictions, low consumer confidence, bankruptcy, and a housing bubble. The housing market was constructed on sand pillars, all of which are ready to collapse. Within the following year, the entire globe will become aware of the housing market's full collapse. At the conclusion of this video, I will discuss which cities will be most severely affected by the impending housing crisis. The United States is already in a housing recession, according to the National Association of Home Builders. In a manner of resembling a bubble, home construction has exploded over the past decade as a result of the enormous gain in home prices. There are a good number of privately owned homes now being built. There are currently around 1.6 million housing units under construction, which is 12.5% more than during the housing bubble of 2008. In the coming months, tens of thousands of residences will be put up for sale, but nobody will purchase them. Currently, month-to-month home sales are falling dramatically. Only 500 million units per year are now sold as new single-family homes, a 5-year low. In this case, not only do we have a record-breaking supply, but also a declining demand. US residents no longer trust in rising prices, according to consumer confidence surveys. Prices of housing. The Wells Fargo Index has decreased for 8 straight months and now stands at 49 out of 100. This is a worrisome trend that puts the housing market's confidence on par with that of the 2008 recession. Welcome to the Financial Flow. Please like and subscribe to our channel and turn on notifications to stay up on our latest videos. Not only the Wells Fargo Index shows a worrying trend, nationwide surveys show poor consumer confidence. Fannie Mae's National Housing Market Poll shows consumer horror. 79% of Americans think it's a bad time to buy a home, according to a survey. 17% of citizens think it's a good time to buy a home. The gap is the worst Fannie Mae has seen since the poll began in 2012. When everyone expects a housing crisis, prices will fall. Record lows in mortgage applications. Mortgage demand is at 22-year low, according to the MBA. Rising interest rates hurt consumer confidence. As mortgage rates soar, mortgage applications plummet. Jerome Powell is adamant about rising interest rates. Powell's recent address at Jackson Hole shows differently. And Powell said, and I quote, "While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation. Powell will keep hiking interest rates regardless of the US economy. Capitalization rates will topple the housing market's pillars. Institutions created housing-related investment products in the past decade. Institutional purchasers accounted for 13% of home sales in 2021, according to NAR, higher than 2020's 11.8%. Blackstone has acquired billions of dollars in new housing units. Capitalization rates, or cap rates, draw institutions to housing. Cap rates are calculated by dividing rental income by market value. A $1 million residence with $40,000 in rental revenue has a 4% cap rate. Powell's plan to raise rates to 4% by 2023 strains the rental market. According to CBRE, the average multifamily cap rate in 2021 was 4.6. The average multifamily property makes 4.59% in rent. Real estate investors' profit margins will diminish as interest rates rise. The discrepancy between multifamily cap rate and 10-year treasury yield grows each month. This differential, called the spread, represents real estate investors' extra profit. If 10-year treasury yields are higher than the multifamily cap rate, investors shouldn't buy them. It's as easy as hitting a button on your iPhone to buy 10-year treasury bonds. Multifamily investing is labor-intensive. If clicking a button earns more money than hiring hundreds of staff to manage multifamily properties, investors would sell their assets and buy bonds. In the past decade, interest rates were 0 to 2.5%. In the past, landlords profited heavily from the spread. The 10-year treasury rate is over 3% and will certainly rise to 4 to 5 or 6%. This will reduce real estate investors' profits or cause them to lose money. Many real estate investors got adjustable rate mortgages as home prices rose. This is disastrous. ARMs have interest rates that change with the market. Due to increasing real estate prices, ARMs have become more popular. Low interest rates benefit ARMs. By 2023, interest rates will spike to 4%, which will hurt ARM borrowers. As ARMs rates rise in the coming year, real estate investors' earnings will fall. Some investors will lose money, especially in low cap rate cities. Many investors have to sell. Some citizens won't be able to pay the additional interest if ARM rates rise in the coming months. A foreclosure occurs 12 months after a mortgage default. Lenders repossess a house to sell it and collect their debt. The 200% increase in foreclosures is just the beginning. Compared to the preceding 2 decades, foreclosures are minimal. With rates rising, foreclosures will soar. Let's resume. Evictions are more pressing than foreclosures. Evictions are rising due to 2 main issues. Connecticut is seeing a large spike in eviction filings. The US forbade evictions during the outbreak. COVID-19 Tenant Relief Act averted evictions during the pandemic. The US Treasury Department gave renters $46 billion. State governments also began rental relief programs. Many states banned evictions temporarily. This government aid averted epidemic evictions. Most of these programs have stopped, increasing eviction filings. Minnesota's Tenant Protection Program terminated in June. In the ensuing months, evictions rose to 50 to 80%. Second, rental rates are excessively high, driving evictions. Due to house price rise, landlords raised rents. Some cities' rents rose 30 to 40% from pre-pandemic levels. Some renters can't pay owing to price hikes. 10-year rent-to-income ratios are over 23%. The average American spends 23% of their salary on rent. It's so high that many people have become homeless. Rising interest rates are bankrupting non-QM lenders. This summer, non-QM lender First Guarantee declared bankruptcy. First Guarantee's lending volume plummeted when interest rates rose. This left creditors $473 million behind. Sprout Mortgage closed in July. As interest rates rise, more non-QM lenders will fall, straining the housing market. Most banks expect a housing catastrophe, though forecasts differ. Goldman Sachs predicted double-digit home declines between 2022 and 2023. With 53 out of 70, I think the home market will decline further. In 2023, I expect housing activity to drop 15 to 25%. The housing crisis wealth effect is significant. A rise in personal net worth increases consumer spending. According to Wealth Effect, wealth can also decrease. If your net worth drops, you may spend less. Studies suggest that housing has a larger wealth effect than equities. For every $1 shift in housing wealth, residents spend 9 cents more over time, according to the NBER. The upcoming housing crisis will affect the whole US economy due to the wealth effect. With property prices falling, you may be worried about your city's housing market. LA, San Jose, NYC, and Seattle have the lowest cap rates. Low cap rates make these cities vulnerable to rising interest rates. Housing starts are another indicator. As indicated before, more home building will boost housing supply. If your city is in these states, Arizona, Montana, Wyoming, and Florida, you are doomed. Nevada, Texas, Mississippi, Tennessee, and West Virginia may see housing prices fall. Thanks for watching. Don't forget to leave a like and subscribe to our channel for more content like this. Have a good one.